Sellable does not necessarily mean safe when it comes to raising capital. There was a time when I was selling a co-working business. It was the best thing since sliced bread at the time. It was the new sort of angle to real estate, and everyone was really backing the whole co-working movement. People were really familiar with it, like the likes of WeWork were promoting massively. And so BarWorks was like this smaller sort of street-facing option that could scale quickly because there were smaller locations. And investors understood it and they started investing very, very heavily. And the company looked real. I mean, it had real locations, real staff, real tenants, the familiarity that, created a lot of confidence amongst the marketplace. But here's what I learned. Sellable does not actually mean the same thing as something that's structurally safe. Money moving around only proves that there's demand and there's appetite for that asset class, right? It doesn't prove that what you're selling is durable. The mistake for me was that I equated all of that traction with a sense of safety. Kind of put me to sleep, and a lot of other people too. And the consequence for that was pretty damn catastrophic for me and the other investors involved, everyone involved, even the staff and vendors. When inflow of capital slowed down, everything underneath it completely cratered, completely collapsed. So the correction going forward for myself is I have two really simplified filters, nothing too complex. Just number one, of course, I want to make sure that something is sellable. So does it fit the risk appetite for the market? Is it a good asset class? Is it something that people want? But the second thing, and this is the really important one, is I want to make sure that the model, the business, and the person running the show, the captain of the ship, can it survive significant levels of pressure? If it only passes the first test, which is it sellable, I won't touch it, because having something that's sellable doesn't mean that it's durable. I want to make sure that if there's pressure, and there will always be pressure, that the sponsor behind the opportunity can actually deal with that pressure and actually stay the course. Because if they can't, it doesn't necessarily mean that you'll end up in a fraudulent situation, but you could end up in a situation where reputation's being damaged, they've overexposed themselves, just incompetency could create a huge amount of issues for yourself, your reputation, your ability to raise capital going forward, raising capital from the same investors. You're burning a lot of bridges when things aren't run correct. So you want to make sure that your sponsor, your deal is structured properly over and above the fact that it can sell well. But just because people want that type of asset class does not mean that you're in safe waters.